The Federal Reserve could respond to inflation with its biggest interest rate hike in nearly 3 decades. Meg Oliver has the details.
The expected interest rate hike comes as everything from gas and food to air travel have seen the largest annual increase in nearly 40 years. President Biden today said reining in rising prices was his top priority.
We put America in a position to tackle a worldwide problem is worse everywhere but here: inflation. It's sapping the strength of a lot of families.
While the Federal Reserve tries to tackle surging inflation, interest rate hikes could potentially create more economic pain for consumers by increasing borrowing costs and discouraging spending.
If they raise rates by too much or too quickly, they run the risk of slowing things down so much that we tip into a recession. And right now, the Fed is in a very unenviable position.
Soaring rental rates in Brooklyn prompted Daniel to put an offer on a home in New Jersey, which he did quickly ahead of tomorrow's action by the Fed.
I would say the only difference is that with interest rates rising, we decided to buy perhaps a little faster than we otherwise would have. We might have spent a couple more months looking if interest rates were still lower.
Mortgage rates have steadily increased this year, already up by 2 percentage points, which has slowed home sales, an average of $550 more a month than a year ago, based on a median-priced house of $425,000.
What does higher interest rates mean for consumers?
So the real direct impact is usually felt with short-term borrowing. That's usually a credit card. But it can actually impact longer-term interest rates as well. And those rates can mean that perhaps you pay more for even a 30-year fixed-rate mortgage.
Experts say if you're considering buying a house, you may not want to wait for the interest rates to go back down because it may be a while. After tomorrow's expected hike, the Fed will likely forecast additional large rate hikes through the end of the year. Elaine?
Meg Oliver, thank you. For more, I want to bring in Aaron Weinman. He's a finance correspondent at Business Insider. Aaron, thanks very much for being with us. As we heard a little bit in Meg Oliver's piece about how an interest rate hike increase will impact Americans, where else will consumers feel it the most?
So for consumers, the short answer here is it's likely to heighten borrowing costs for the consumers and for companies because the Fed's essentially going to cool the economy down, or at least try to, from the pandemic-induced binge that we did go through the last couple of years. The worry here is that we're all pretty convinced that inflation is sticking around for the near term. And when people expect inflation, they tend to accelerate their purchases, before things become more expensive, and that can fuel demand and sadly more inflation. So long story short, the Fed needs to use the tools it has to quell consumer spending, wage gains, and economic growth.
So let's dig into that a little bit more and break this down for our viewers. Can you explain, Aaron, what the federal funds rate is, and how could that impact people's savings accounts and retirement plans?
Sure. So really simply put, the federal funds rate is, think of it like your cost of borrowing, right? And tomorrow, the Fed's expected to announce what could potentially be a 3/4 point rate hike. And that would be the largest it's done since 1994, if I'm not mistaken. And so the expectations now are that those rates could swell to about 3% by September. And in terms of how it impacts your wallet, at the heart of the Fed's move here is to shift the spending behavior on people, shift people's spending behavior, I should say. So in recent years, it's actually a nice sign, people are by and large saving more money and for the most part being pretty prudent about how they manage their accounts. So I suspect the cooling of the economy will have an impact on this further. History would suggest that people's investments, retirements or college savings accounts will shrink and they'll need to pare back their spending habits.
Well, what about mortgage rates? Mortgage rates have already surged in response to the Fed's rate increases this year. What does it mean for the housing market potentially?
Absolutely. So just like other borrowing costs, fixed rate mortgages are getting more expensive as a result of sharp increases in the consumer price index. So I believe the 30-year jumped to about 5.9% from 5.6 last Friday. And that was one of the biggest jumps, or one-day jumps, I should say, on record. This is in stark contrast to the roughly 3% that folks were paying on their mortgages last year. So therefore, would-be home buyers in the market, this is something the Fed, they likely want to cool that down as well, if that makes sense. And by extension, the housing market will cool down. So, I mean, I'm no housing expert, but my thinking is for those keen on buying a home, it might be worthwhile exploring an adjustable rate mortgage. But then you are at the mercy of floating rates, which will, in all likelihood, probably move higher. And secondly, people could take out longer term loans. You know, this brings down your monthly payments, but you do pay more interest over time. So it is a bit of a double-edged sword, to be honest, but it's all part of this. I'll take it back to the sentence I said earlier about just cooling that economy down, because it did get, as you know, very, very hot in recent years with pandemic-induced spending.
Yeah,
and the housing market is one of those areas.
It sounds like a lot of factors for potential home buyers to consider. But just looking sort of more broadly here, you touched on this a moment ago. There's been a massive sell-off since that report on inflation last week. Why exactly are investors on Wall Street so concerned?
Short answer is inflation. Again, it's a word that you're going to hear a lot for some months now. Inflation and constant rate hikes, they're going to drive volatility. It's a very reactionary market, and market experts have been, and they will continue to price this volatility into their statements, into their estimates for some time to come. The Fed's being very clear about its intentions as far as rates are concerned, and as a result of that, as you can see on the screen there, everything is going up, right? Mm-hmm. However, company valuations have come down. And I think what's important here is a lot of the stock indices, particularly the NASDAQ, is very reliant on tech company valuations. And tech companies have been very highly valued for some time now. And as the market is in the red, as you can see, tech valuations are driving a lot of that pain, if you like. And as a result, that has a domino effect onto the rest of the index, or indexes, I should say.
Bottom line here also, all eyes on the Fed on Wednesday to see what happens, and people are watching those 401ks and trying to make sense of this volatility. Aaron Weinman, thank you so much for sharing your insight with us. We really appreciate it.
You're welcome. Thank you for having me.